Welcome to our video on prepaid expense balancing. Today, we're going to explore one of the most important accounting concepts that can make or break your financial reporting. As a business owner or accountant, you're likely familiar with prepaid expenses. But do you know how to properly balance them in this video? We'll take you through the ins and outs of prepaid expense balancing, explaining what it is, why it's crucial, and providing examples to help solidify your understanding. By the end of this video, you'll have a clear grasp of prepaid expense balancing and be able to apply it to your own financial situations. So let's dive right in. So, what are prepaid expenses in simple terms? A prepaid expense is an asset that represents a payment made in advance for goods or services yet to be received. Think of it like buying a gift card for a friend. You pay for the card upfront, but your friend might not redeem it until later. Prepaid expenses can include items like insurance premiums, rent, and software subscriptions. When you initially record these payments, they're considered assets on your balance sheet. However, over time, as you use up the goods or services, the prepaid expense needs to be expensed out, reducing its value on your balance sheet. This is where prepaid expense balancing comes in. It's a process that ensures your financial statements accurately reflect the remaining prepaid expenses and the expenses already incurred. The goal is to match the expense with the period in which it was incurred, rather than when the payment was made. For example, let's say you pay an annual insurance premium of $1,200 on January 1st. At first, this would be recorded as a prepaid asset. But over the next 12 months, each month, you'd need to expense out $100, 1/112th of $1,200, to accurately reflect the monthly coverage. Now, let's talk about how to balance prepaid expenses in your accounting system. There are generally two methods, the straight line method and the actual usage method. The straight line method is simpler and assumes that the prepaid expense will be used up evenly over time. On the other hand, the actual usage method takes into account any changes in usage patterns. For instance, if you purchased a software subscription for $1,000 per year, but only used it for 9 months due to a project cancellation, the straight line method would still assume 12 months of expense. However, the actual usage method would adjust the expense period to reflect the reduced usage. To recap, prepaid expense balancing is crucial to ensure that your financial statements accurately reflect the remaining prepaid expenses and the expenses already incurred. Remember, prepaid expenses are assets representing payments made in advance for goods or services yet to be received. The goal of prepaid expense balancing is to match the expense with the period in which it was incurred, rather than when the payment was made. There are two main methods, straight line and actual usage. And that's a wrap on our video about prepaid expense balancing. We hope this explanation has helped you understand this critical accounting concept. We were honest, if you have any questions or need further clarification, please don't hesitate to ask in the comments below. Don't forget to like this video and subscribe for more content focused on helping you master your finances. Until next time, stay financially savvy.